Hi, you're watching Russell Market Week in Review for the week ending May 8th, 2015. I'm Mark Supase, and I'm coming to you today from Russell's world headquarters here in Seattle, Washington. I'm joined this week again by Erik Ristuben, our Chief Investment Strategist. Erik, good morning.
Good morning, Mark.
Good to have you back. And we start here in the U.S. We had the April jobs number this morning, slightly better than consensus, but we also had a revision of the March non-payroll number. On balance, though, the market seemed to like what they saw today.
Yeah, they did like what they saw. Now, actually, the number was significantly better than what we were actually forecasting. We had a number of 185,000 jobs. Okay. Now, we knew that the surprise, kind of risk to surprise on the upside was greater than the downside. Sure. But, you know, I think the important thing here is that it's our expectation that the U.S. economy is going to accelerate off of the first quarter very slow growth that we saw. Okay. And 223 jobs, or 226 jobs rather, 1,000 jobs is actually right in line with that. Right. The thing about what happened today in terms of the jobs number, I think, is that the market's come to the conclusion that March is the aberration. Okay. You know, because it went down to 85,000 jobs, and I think people were concerned, they're really concerned about that March number, saying, well, the economy in the first quarter clearly was bad with a 0.2 print on GDP, and they wanted to see evidence that it was reaccelerating. I think this jobs number gave them enough evidence that the U.S. economy isn't dead yet. Okay,
and you kind of net out the March number and what we saw today, and it's about right where we thought.
Yeah, I don't think that way it works, right. But we'll take credit.
We'll take credit for that. Okay, what do you make of the spike in 10-year Treasury yields this week? And what should investors be looking at there?
Yeah, it's interesting. The equity market, the Russell 1000 was basically flat. I mean, I think it's up 20 basis points on the week as we talk. But the 10-year Treasury yield has been Mr. Toad's wild ride. Right. I mean, we went from a little more than a week ago at 190 something, 1.9% on the 10-year yield, all the way to 2.43% on Wednesday, and now we're back to 2.12. So I think what's been happening here is that we've been talking a lot about the natural fundamental pressure on the 10-year yield is up. Right, the economy in the United States continues to grow. Inflationary expectations we think are beginning to build. Right. The ECI number, the employment cost index number that we saw last week was supportive of inflation maybe becoming an issue. So that should push rates up. But the thing that's been keeping them down is the Bund. And the Bund was at 8 basis points, kind of when the U.S. Treasury was at 1.9. The Bund moved a lot. It's at 53 basis points as we sit here today, or as we talk now. That's not 53 basis points for a 10-year loan to the German government isn't a lot, but it is notably more than 8. And I think that the fact that the 10-year Bund yield went up was what's allowed the 10-year Treasury to go up. The 2.43, I think, was some people that were having to cover off on levered trades on the wrong side of the trade. They're having to cover some of their positions. I think we're going to see upward pressure throughout the year on the 10-year yield, but we have to see that Bund also continue to move up as well.
All right, and so just to wrap up then, I mean, you mentioned the Bund, and just to transition to Europe, we saw some retail numbers this week that I thought were decent. The markets were generally positive in Europe this week, but is what we saw, Greece is still in the headlines. Right. Is that a result of what we saw, or a driver of what we saw with the Bund?
I don't think so, and I think that may be something that people are connecting, that the Bund yield went up because stability risk in Europe. I'm not sure how people are reading that. Right. Our opinion on Greece is it remains the same. Greece, we think, is unlikely to leave soon the euro. I mean, it is still hugely politically popular within Greece to stay in the euro. So I think the odds of them leaving are very low. But even if they do leave, we just don't think there's a huge contagion risk. Firewalls have been put in place. I think what happened with the Bund has been the fact that people are realizing the European economy is in better shape than they expected. And again, for the same, and so what happens is when the economy's in better shape, people's expectation for growth goes up, their expectations for inflation go up, and as a result, interest rates tend to go up. So I think the Bund move is not so much about, not really anything at all about Greece. The equity market being up, the stock 600 up about 1.26%, kind of, I think, supports that. I think this is all about the fact that things are getting better in Europe, and because they're getting better, which is the goal of quantitative easing, I think rates are starting to move up.
All right, good stuff. Erik, as always, thanks for being with me.
You bet.
Appreciate it. Appreciate you joining us on Russell Market Week in Review. We'll see you next week.